Good morning. Happy Monday. Welcome to Power 30 Live. Today we're talking to Dean Dovolis about modular construction and how he can get that cost down by a big number. You're going to want to pay attention to that. We also had events in St. Louis, Minneapolis, Illinois, and Texas. We're going to recap those events with economists, with industrial real estate, with multifamily. It's going to be a great show. Power 30 starts now. Welcome to the news. According to an article by our own Matt Baker, retailers may not be able to rely on this year's holiday shopping to put them back in the black. Fears of an extended recession have been somewhat allayed by consumer confidence because retail sales are still exceeding pre-pandemic levels. This doesn't mean, however, that brick and mortar stores can rely on holiday shopping to put them back in the black. A CBRE report identifies 4 trends that we should expect to see this year. 1, a slowdown in brick and mortar sales. 2, an extended shopping holiday season. And 3, a second surge in e-commerce sales. 4, an attempt by physical retail to balance safety with experience. Front Yard, the single-family rental company, will go private in a $2.4 billion deal, according to Globe Street. Transaction will be led by Pretium, along with a group of its investors and fund managers, by the real estate equity and alternative credit strategies of Ares Management Corp. Try saying that really fast. When the deal closes, Pretium said it will be the second largest owner and operator of single-family rental properties in the United States, with a portfolio of more than 55,000 rentals. Don Mullen, CEO of Pretium, believes that the company needs scale to achieve its goals. I got to think 55,000 better be scale. In another Globe Street article citing data from Real Capital Analytics, institutional investors are still net investors in 2020, meaning they are buying more than selling. This could turn as recovery continues, given institutional investors have the ability to wait for things to recover before selling. But for now, the buyers outpace the sellers by $9.6 billion. In our continuing quest to bring you REIT market information, this week we are looking at REIT preferred stocks. Preferred stocks carry a more favorable liquidation preference compared to common stocks, and they often carry more yield. Preferreds, however, are typically limited in the liquidation price, thus limiting your upside. It's often the same as their initial purchase price, typically $25 a share. Investors we have spoken to will look at the spread between common dividend and the preferred dividend when looking at which to buy, in addition to where the common shares are trading. I can't give you investment advice, but here's a chart showing some of those deltas. 52-week high of the common, 52-week low of the common shares. You can see where sometimes it makes sense, sometimes it doesn't. We'll keep an eye on these preferred stocks along with common stocks from our equity desk, Jackson Phillips, as we go along through this show. At a recent RE Journals conference addressing the condition of healthcare real estate in Illinois, many are seeing positive signs for the asset class, even though the continued COVID-induced struggles. Amy Sovine of Physicians Realty Trust commented on potential M&A activity.
I'm going to go out on a limb and definitely say that there's going to be some increased merger and acquisition activity, M&A activity, hopefully some monetization opportunities where a lot of these health systems that have been holding on to their real estate will look to some buyers out there like Doc and be able to unload some of their real estate, monetize and capitalize on that. But in terms of how healthcare is being administered, I do think it's gonna continue where you're maybe not in the waiting room anymore. You're in the car waiting for your text message, or you have to be in the waiting room alone, reducing the number of people that can come along on your visit. continued screenings, temperature screenings and questionnaires over the phone before your visit or when you arrive for your visit. And of course, everyone knows telehealth isn't going away. So just figuring out how that looks and works in the physical office environment is kind of on the horizon here.
Brian Howard, president of Sage Equity Partners, and Joel Magliochetti discussed off-campus real estate.
Micro hospitals or neighborhood hospitals, certainly they can be run more cost effectively than a major hospital and can perform almost all the same services as a full-blown hospital. They perform inpatient. You can be there for several days, but if you have the highest level of care required, then you could be transferred to a main hospital. Otherwise, it's ambulatory locations at main and main intersections, the highest visibility, highest traffic, highest accessibility to the patient base. Exploring drive-through vaccinations and testing as a permanent fixture. So where we've all seen the pop-up drive-throughs for swabs, really asking if that's going to be a permanent part. If you need to get your flu shot, why are you going into a medical office building and sitting in a waiting room where there's people coughing and you wait 20 minutes and then you go and get your shot and you go? Why not just drive into a permanent facility and get the shot in the arm?
I think the shift to outpatient and off campus it was the momentum earlier, and it's identified as what's going to happen now. I mean, during COVID, in the heart of the pandemic in March and April, I think hospitals realized that their core competency needs to be treating the sickest folks in their hospital, and they were looking for space from groups like us to temporarily put uses in some of our buildings so they can free up space within the hospital. So I think the move to off campus is key to the business. And when you look at off campus plus the demand driver, I think that's why healthcare is sustainable in the face of a recession, in the face of effects of COVID.
You can find a summary of this conference on the rejournals.com website and the entire video on our YouTube channel, where you should be watching this show. Alfredo Gutierrez, CEO of Sparrowhawk and one of my favorite people, spoke at an RE Journals event in St. Louis about the St. Louis industrial market.
Investment sales in St. Louis, in particular, and some of the other secondary markets, has really escalated. Going into the COVID end of 2019, early 2020, you're already seeing institutional investors realizing that the second tier cities, and not just the gateway cities, had a place in their portfolio, and they were looking at and investing in those markets. St. Louis was one of them. St. Louis was trending a smidge behind some of the other cities, as the previous panel indicated on apartments: Cincinnati, Columbus, Indianapolis, Louisville. But it continued trending down in cap rates and increasing in price per square foot, and development continued to grow. Positive absorption continued to exist, and those were all good attributes for any investor. COVID hit, and what happened in investment sales was it kind of dried up a little bit. There was uncertainty from lenders and, to some regard, investors as to what impact this would have. It was quickly realized that the effect on industrial was going to be marginal, if at all anything. And you began to see single tenant buildings trade, not to the level they were trading in 2019, but there was still an appetite for it, and cap rates continued to compress. And there was scuttlebutt, because nothing ever traded there, that cap rates may have moved 25, maybe 50 basis points higher on some of the multi-tenant product or some of the smaller product. As we have seen over the last 45, 60 days, activity level as far as marketing goes from the brokerage houses has boomed. I can't, focus on the number of deals that are coming across my desk. That's the volume that's coming, and more coming every day. And what I'm seeing is it is trending down in cap rates, and as already indicated, pricing is going up, and in particular in this city and some of the other secondary cities, but in this city more so than some of the other secondary cities, because there was a gap already between where St. Louis was trading and where Cincinnati, Columbus, Indianapolis was trading. All those were trading at a small discount to the regional hub, which is Chicago in this area, where St. Louis was trading at 50, maybe 75 basis points higher. So you're seeing a compression. That's here to stay. The Fed has already indicated that rates aren't going to move. They've already said that they're going to keep Fed funds rate probably flat for the next couple of years. I predict it's for the next 7 to 10 years. And the reason I predict that is if you look at the trend, what happened after the Great Recession and the pandemic, you could argue that some of the economic numbers in the Great Pandemic are worse than the Great Recession, the financial recession, on unemployment and some of those other factors. The Fed funds stayed flat for 7 years after we came out of the financial recession. There's a much bigger impact to unemployment and the image of what occurred during the COVID pandemic. I believe the Feds are going to keep that fund lower than 7 years. It could be 10 years. So in the near future, we're at low interest rates.
Alfredo went on to talk about how Amazon has brought more investors into the market, but that industrial is much more than just Amazon.
Industrial, that's a garage. It's a cement box. Why would I ever want to invest in that? I don't get that. But they're now starting to understand the fundamentals in it. And not only that, thanks to, Big Smiley, Amazon, everybody gets it. And they all think industrial is Amazon, which is, as we all know, false. E-commerce is about 20% of the retail sales. At the end of 2019, depending on who you read, it was around 14, 15% of retail sales was e-commerce. Amazon is about 20 to 25% of e-commerce. So if you do those numbers, you're like, well, Amazon's really not industrial. It is part of industrial, but it is not industrial. The advantage is they've been growing like crazy, putting up 2 or 3 boxes in each market. As we already indicated here, two big boxes have come into this market. And the reason they're doing that is they're realizing with going from the just in time concept to the just in case concept, which was easily understandable to the common person by saying, could you find toilet paper during the pandemic? They get disruption in supply chains. That's all you need to tell them. That existed, but it existed in a lot of products. So what they're seeing is we still need the gateway distribution point, which is Chicago in this part of the market, or Dallas to lesser extent. They still need that. But you also need some decent sized boxes closer to the population. That's what Amazon's doing. That's what all the other big box retailers are doing. And it's amazing to look at the numbers. I mean, e-commerce during the pandemic went up by over 200%. So we went from 15% to 35, maybe 40%. It is settling back down, but it's still going to be much higher than the great acceleration we were having pre-pandemic. it'll settle down to be north of 20%.
We will have to have Alfredo on for a full interview before the end of the year. Dr. James Gaines, chief economist at Texas A&M Real Estate Center, joined us last week for a Red News RE Journal's Texas Multifamily event. Dr. Gaines gave us an update on where the economy stands, followed by how the multifamily market will be affected, specifically in Texas, but also across the nation.
Everybody knows by now we're in a recession. We're officially in a recession. The National Bureau of Economic Research has declared that February was the peak month of the prior cycle. That was the 128 months since the Great Recession, when the economy was on a roll and everything was copacetic and recovering from the Great Recession, from the Great Recession, the financial collapse back in 2007, 8, 9. And since then, the first quarter of the year, you can see it out there on the right, the first quarter was down about 5%. The second quarter down 31.4%, according to the statistics. And this is an annualized quarterly change, so it's a little bit different calculation. But when you get 2 quarters down, that's an official recession. It's interesting because the decline in the second quarter, and of course that's not to be unexpected, because basically we were all told to go home, shelter in place, and stop everything, and companies stopped and closed down and so forth. So that 31 point, that's the worst on record, and it's ironic because the third quarter number, and it hadn't come out yet. We don't have the actual number yet, but the best guesstimate is going to be somewhere between 25 and 30%. And there are some guesstimates that are even higher than 30%. That's going to wind up being the best quarter on record. The problem is the way that rates of change work. If you go down 30%, you've got to come back up about 50 to 60% just to break even. So it's going to take us a couple of quarters to really even break even. You can see the prior quarters back to the left. On a year-over-year basis, second quarter was down about 9.5%. We'll see third quarter will be a little bit different than that. How bad is it, or how bad has it been? Well, second quarter, worst on record. We've had over 63 million people file for unemployment claims since March 15th. This is through about a week or so ago. Texas, we've had a little over 3.6 million people file for unemployment. About a quarter of the workforce. I'll show you a few more statistics here, because getting people back to work, getting those people back to work. In April, officially, we lost about 20 million jobs. And we've not recovered all of those jobs. We've only recovered right at about half, more or less. And in Texas, we're still down almost 650,000 jobs at a statewide level. The Texas, of course, has gotten hit with a double whammy, as all of you know. Starting in January, early part of the year, Russia and Saudi Arabia decided to have a price war on oil. Price of oil started going down. The energy market collapsed. And in fact, by mid-April, if you'll recall, the price of oil actually went negative $35 one day. Just one day. And that's interesting. How do you have a negative oil price? Well, the producers were literally having to pay people to take the oil off their hands. That's a negative price to the producers. We've had some recovery since then. It's been hovering right around that $40 a barrel mark here for several months. And for all intent and purposes, it looks like it's going to kind of stay there. We've got a bunch of mortgages. These are home loans that are in forbearance. There are a lot of commercial real estate loans, also multifamily loans. That's not as easy a data to track. So I don't have good hard numbers, but about 3.4 million, 3.5 million mortgages in forbearance. And that's going to be an issue probably coming up, about second quarter of next year, as a lot of the forbearance programs give out, or the time period gives out. The deficit is going to reach somewhere around $3 to $4 trillion this year. It's a heck of a lot of money. It's probably worthwhile in the short run because we needed to have all the fiscal stimulus we could get. In fact, as you well know, Congress is still bandering about with whether another stimulus bill that they really needed to have done about 45 days ago, and they're still debating it. Politics, of course, always gets in the way of good economics. So we'll just have to see how that goes. That's going to be the problem a year, 2 years, 3 years, 5 years from now, is the level of debt and commercial and federal sovereign debt that we're going to see. Here's the unemployment claims. The claims, new claims data for the last week just came out this morning. I haven't had a chance to update the slide, and it actually bumped back up a little bit. It was back up just shy of 900,000. Almost a flat looking thing, but the interesting thing, we thought that the recovery was going to start hitting into these unemployment claims a little harder and have them go down a little bit more on a week to week basis. And as many of you who are tracking all this know, the case counts are going up and it's coming back. You can see over to the left, that's what it should look like. And we're still just going along. What's it going to take? Well, the first thing it's going to take for a full economic recovery is we've got to get the virus under control. I don't know what under control means. It probably won't go away completely, but we've got to get it under control, whatever that means. We've got to have either a vaccine or we got to have some way of treating it or whatever. And that leads to jobs being created, people having money, increasing overall general demand, and people and businesses spending more money. Global trade's not going to be a help. Inflation is not a concern at this point. It's going to be a concern about 3 or 4 or 5 years from now for those of you who want to watch that. Interest rates are going to stay low. We'll just have to see. And taxes and spending are eventually going to catch up with it. Evictions are going to be an issue. We know there's a moratorium, and it's kind of interesting, some surveys that have been taken. And what you see is that generally it's hitting the Class B, C market harder. It's hitting the lower rent apartment market a little harder. 54% of the people with less than a high school education, which means they're probably paying less than top rents. But 54% think they may be evicted sometime in the next 2 months because they haven't paid the rent. And you can see how that percentage decreases. So it's 34%, but even that is a very high percentage. In fact, in Texas, about 30% of Texas renters in the survey by the Census Bureau said they expected to be evicted. Now, the time period was a little bit more, but it was next 2 months. And that's kind of interesting because the apartment market is also reporting they're having a little trouble releasing vacant or evicted apartments. People are, of course, there's some that are doubling and tripling and quadrupling up into the same unit, but it may leave another unit empty in the process of doing it. You can see that Texas has held up reasonably well in terms of the percentage of renters who are paying the rent on time. First week in October, the report was that the percentage was better or equal to or better than the percentage of the first week in October last year. So again, this thing it's very variable and it's very spotty. It could be individual properties and individual markets.
Thank you, Mr. Gaines. Next, we're going to go to Dean Dovolis, CEO of RJF Architects, has some very interesting information about modular housing in the case of high-rise or mid-rise multifamily apartments. This has legs, folks. Pay attention to this interview. The whole interview can be found on our podcast on Spotify. Take it away, Dean.
Okay, my name is Dean Dovolis, and I'll just walk you through my background. Founded the firm in 1986. As when DJ was established, my educational background was University of Minnesota, where I graduate degree, Bachelor's of Architecture and Environmental Design, and then I attended Harvard University, where I graduated with a Master's of Architecture and Urban Design. That's my background. Afterwards, I founded the firm in Minneapolis because I didn't really want to work for anyone, so the firm was really founded in 1986. And it was founded in the Phillips neighborhood, and we actually became a resource for the community, and we did a lot of affordable housing, a lot of community-based housing, commercial projects, things like that. So firm's birthplace was really 11th and Franklin in Minneapolis, and then that's where we got our community background in housing, and that sort of stayed within the DNA of the firm ever since till today, where we still do a lot of affordable housing, health community groups, and so forth. And actually, we're involved with a very interesting issue. I'm being interviewed with the Minneapolis St. Paul Magazine tomorrow on some of this community activities and so forth. So then the firm continued to grow. So we basically outgrew 11th and Franklin and ended up moving to the building we're in right now, which is Union Plaza in the warehouse district, because we basically have a whole floor within the building. The firm's grown to about 50 people, and we just added an interior design department to it. And so far, so good. We've been still growing rapidly and still looking for people. So it's been a blessing on that basis. And quick story, the recession hit, DJ was buried, you know, clients went bankrupt, we were stuck with receivables, you know, the whole thing. So I took off to North Dakota, drove up there to find work because I heard about the oil fields. And it worked. We found work. We started laying out cities, buildings, apartments, stuff like that during like 2010, 2011, when the rest of the world was dying. I was able to find work to keep the firm alive. And it was a blessing I went. There I got exposure to modular housing, started working with it. It wasn't good quality, and it was a lot of home guys that, you know, people that built Ramblers converted because they needed housing so fast to satisfy the oil boom. I started working on modular apartments and putting them together, you know, with my partner Scott England, and putting these together and making them work out there because the delivery was fast, efficient, and the timeline collapsed beautifully because they had such an acute labor shortage. It was the only way to get housing done. So I started to cut our teeth on it out in North Dakota during the oil boom and did multiple projects. But I saw how this worked. And I saw the efficiency of it and the ability to deliver quality housing at a fast pace. And I toured the factories, understand the system, and studied it there. But they were what I call first generation factories. And they were done using a rail bed basically and tracks to move the modulars around. So if you imagine, and then so the bed sort of caused the unit size to be fixed, and you didn't have the flexibility, and you had to sort of work within certain criteria. So it wasn't as adaptable. I had the privilege of meeting Christian Lawrence through a common business person working with Sweeney, and he talked about putting this modular plant together. And I said, well, I'm familiar with it, and so forth. So we basically started working together to educate ourselves, modify the systems, work it, and, you know, blessing by Christian, he had the resources to get it done. His father, James Lawrence, very successful in business, was CEO of PepsiCo, and a whole bunch, founded Bain Company, a whole bunch of stuff. So he had the assets and the experience to drive it. Christian had a desire to develop it, and so I knew this was a possibility to stick with. So I started working with him, learning the system, seeing him put his plant together, and what he did different, because his plant was being created new as opposed to historical under the old method, and he bought a large building in Owatonna to the south. But their method is using air pods. I may think that's very simple. The units are hauled around on air pods that are underneath, and you just push them along. Two people can move the modules around, you know, and these weigh multiple tons. And that really loosened up the flexibility. Such a simple idea, but it created it. And then you use overhead cranes, and we organized a computerized mill so the lumber was efficient. So the beauty of it, this was a plant built just specifically for multifamily construction. Everything's delivered to Owatonna, and it's all the inventory there. And then I put in everything in that factory, the cabinets, everything, all the components are there. And it's really efficient because you're not having to take up elevator stairs. It's just another step in the price. As the units move around the air pod, you know, and, you know, so you make, you know, the manufacturers, you make the floor on a bed, then the walls and the ceiling are made separately, then the box all come together simultaneously, and then it starts moving through the around the factory at each step, electrical, mechanical, plumbing, sheetrock, windows, insulation, as we go through. Then, as they get further down the line, all cabinets are installed, all finishes, all tile work, all done. So each has a station. And then the unit is bundled up and complete on that process. So all the inventory is sitting on the factory floor waiting to be installed in the unit once it gets to that proper point and dropped in. So it really speeds that installation of cabinetry or furniture or toilets up considerably, because all you're doing is taking it from outside the module and put it inside the module and installing it. So you're walking 5 feet and dropping it in, and the inventory is stacked there all ready to go.
So I had heard you say cost savings, and you don't have to tell me a number, but I'd love it if you did, that you could ballpark, if a developer is sort of penciling it out on a napkin, cost versus traditional on modular.
Well, if I can get, it can get up to 50% with scale. With scale, I can practically have numbers, especially I have a very efficient building on that. I have, working with Christian, a new way of delivering housing affordably and very good quality housing affordably on it. And I give Christian credit too, at the same time, he invested in building his own project, which is Mod 42, which is a 30-unit project on 42nd Hiawatha, just west intersection, to test drive it, work out the bugs, go through it. So we had a model we were studying. We did the drawings and figure out it. You have to learn a whole new language, architect, to do modules. I can't do how I did in the past, and I'll get into that because that's sort of an important process. So we pulled it together at the same time. I was really pushing my clients really, really hard, saying I can deliver a project cheaper and better and faster and make affordable housing without subsidy. We have a methodology. So credit be given, Stu Ackerberg is another who's a person of a lot of creativity, and you've seen his projects, and eventually said, I will do this. And we did a lot of research, and we tested Christian, the modular housing, against conventional contractors. So we started doing the side-by-side research, the side-by-side scheduling, the side-by-side to really understand the market, really understand how it comes together and so forth. And it proved itself price-wise. It stood up to the test of my most efficient client versus a modular, in terms of contractor design builders versus modular. It stood up the test of time and the test of budget and the analysis. And Opus came in as a GC to analyze it. So we really went probably above board researching it, but it was probably worthwhile because this was untested, untrue. And I got to give credit for Stu for standing up and saying, we'll make this work. Because Stu couldn't get the budget there. And I said, I can get your budget there doing this methodology. And he was willing to take that risk. Now that project's on West 7th. It is in production in the plant in Owatonna. It's going to be built, and it's going to be a 7-story modular building on West 7th in St. Paul. And in that project, actually, had 2 innovations. Again, credit for Stu. He was willing to do this. It has an automated parking. So between the automated parking and the modular house, I made a very tight site. And the site's a long, skinny piece of land, commercial site, where I was able to get 192 housing units in and a good inventory of parking in this site, in the basis. So that will be the tallest modular structure going up in the Twin Cities. And then I have to give credit to Bob Lux of Lattice. His is next. He'll be the largest modular structure in Twin Cities, which will be 300 units. That's going to also have to be built in St. Paul, right off the University in Lexington. So the market is, we've had some front runner or unique developers that are willing to look at this model, and they're seeing it. They're seeing the savings. Really went through the research deeply with Stu. Bob had the same discussion. See, Bob, he said I can't make it work. So we redesigned his project to make it work. So he took it from traditional drawing that a different firm did and redesigned to make it modular. And that made the difference of not building it versus building it. That got the budget and the price points in line.
Now, are they market rate apartments or are these affordable?
They're market rate, both are
Market rate.
market, but the cost savings makes it competitive. And if you do a low-rise building like Mod 42, where let's say I do a building that has no parking or just limited surface parking, no elevator, then I can deliver natural, they call it NOAA, which is natural affordable occurring housing. They call it, so I can deliver 60% adjusted median income housing, and that qualifies as affordable housing by state and federal regs without having subsidy, and that's a big deal. So now I'm starting to serve the deepest part of the housing market, the most underserved, that I can make housing affordable for people that are making $42,000 a year, because that's what 60% AMI equates to, and they spend no more than 30% of their income on housing. So that's sort of a big revelation on the affordability of housing